Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So lately I kind of have neglected the UK based companies. We haven't done actually a lot of analysis on UK based companies, and sometimes I'm just a little bit not too sure whether I should do basically some analysis on these companies. I do own some of them, and the ones that I own are actually globally diversified companies, but there are of course other companies in the FTSE 100 that we haven't actually basically looked at in age. So what I would like to do today is share with you guys 6 companies that in the FTSE 100 that could potentially be a good basically buys moving forward, inshallah. I'm not saying go away and buy them. Of course, you do your own research and so on. But before we do that, I just want to also go over one of the reasons why I'm a bit hesitant to invest a lot of this money into the UK companies, okay, especially right now. Moving forward, maybe inshallah things might change, but right now there's a reason why I'm a bit hesitant, and I will talk about that in a second. But before I do that, please like the video, subscribe to the channel, and let me know if you have any questions, because that really definitely helps the channel. As well as, of course, if you can join us in the Patreon account where you get access to the Discord where a lot of brothers are sharing good practices, that will be really good. And also I share all the buys and sales, and you get access to all of these things, including the Sharia compliant investing ebook and so on. So this is one of the reasons why I'm actually a little bit hesitant to invest in the UK stocks right now. A lot of our UK companies have not done well for quite some time. So if we compare the FTSE 100 against the Dow Jones, the S&P 500, the DAX, which is the German equivalent of the S&P 500, and the CAC, which is basically the French 40. Okay, now if you look at the FTSE 100, a year to date is only up 2%, 2.7, rounding up to 3%. The Dow Jones about 4.5%. The S&P 500 double that, 10%. The DAX is actually about 10%, and then the French basically 40 is actually 8.6%. So not bad, okay. But right now the rest of them are okay, kind of more or less the same. The Dow Jones, remember, is only 30 companies in there, and these companies are, some of them are very stable old companies in there, so they don't have those high flyers that the S&P 500 has and so on, and especially with the AI and everything else. So the Nvidias and all of that, they're not in there. They are part of the S&P 500 rather than the Dow Jones. So but still the FTSE 100 has actually not done as well as the Dow Jones. It's almost basically doubled. Now when we look at it for the 1 year, okay, if we look at the 1 year returns, it's 6% for the FTSE 100. The Dow Jones is about 21%, 31% for the S&P 500, and then so on. And every single one of these indices actually has beaten the FTSE 100. Okay, and I'll tell you exactly one of the reasons why that is happening. Okay, and if you look at the 5 years, it's even worse. So for 5 years, so imagine every single company in the FTSE 100 was Sharia compliant, and you just bought the index for the last 5 years. You've been buying every single. You will be up just about 10% right now. The Dow Jones will be about 50%. The S&P 500 over 80%. Okay, and then 59%. If you invested your money in Germany, you'll get 60%. And the reasons why these French and the Germans and whatever have done better is because their economies are doing way better than basically the ones that we have in the UK. UK, we are full of, back in the days, it was all the mining companies, oil companies, utility companies, those dividend heavy paying companies that have so much in debt, and they can't reinvent it. Basically, they can't invest in innovation or anything like that. So whereas in the UK and other places, and US and other places, have got other companies. They've got the pharmaceutical companies that the biotech companies. They've got the companies like the Nvidias, the technology companies, and everything else. The Teslas, the consumer discretionaries. Their businesses, their economies are doing way better than the UK, and for that reason, the FTSE 100 has done absolutely nothing. For 9% in the last 5 years. So that's absolutely ridiculous. So this is one of the reasons I've kind of overlooked the FTSE 100 stocks. I do own a few of them. I'll share that with you guys in a bit. But yeah, so that's one of the reasons. I hope that makes sense, because I know some of you have always said, why don't you invest a lot on the FTSE 100? companies, the UK based companies. I do like some of them. I do like the fact that there's no FX change, the impact and so on. There's dividends. There's not actually 15% cut every time I actually get whatever. So all of these things are positives, but for the long run, I'd rather, even the next 5 years, have 84% up basically in my portfolio than actually just about below 10%. That's just not even beating the inflation right now. Well, a little bit beating the inflation, but not much. Okay, and that's the reason. Now let's go and start and look at the 6 companies. So I'm going to give you a quick overview of the companies, but you're going to have to go away and do your own research. So first company is, we're looking at Relics. This is one of the data analytics companies. It has a market cap of 64.7 billion market cap right now. Has a wide economic moat. Price at the time of recording is £34. Dividend yield of, oh, by the way, this is a all in pounds. Okay, so dividend yield 1.7, payout ratio 62%, and the dividend streak of 10 years. So they have increased that dividend for 10 years, and according to Simply Wall Street, is actually safe. Profit margin is about 19%. Free cash flow 1.9, so almost $2 billion pounds of free cash flow right now. Forecast annual earnings growth for the next year to 3 is about 9%, which is really nice. The revenue growth rate is about 6%, and Simply Wall Street is actually saying is overvalued by almost 11%. Their fair price is actually £29. Right now it's about £34, so a little bit expensive. But according to Morningstar, it's 6% discounted, and that's $46 right now. You can just do the conversion yourself. You could see the difference, the price wise. The next one that we're looking at is AstraZeneca. This is one of the companies that I own in my portfolio, and one of the biggest pharmaceutical companies out there. Is 161 billion market cap. Pounds market cap right now. It has a wide economic moat. The price is right now $104 pounds per share right now. Dividend of 2.2%, payout ratio 75%, and dividend streak of basically 10 years. Now if you use Simply Save Dividend, Simple is different because it says it has not been increasing or anything like that. But when you use Dividend Max for UK based companies, let me quickly show you. You can see according to Dividend Max, is actually the dividend is growing, but of course some years it is cut a little bit, or they don't grow, and some years they do. So we are basically, it's not consistent enough. However, it is safe, and that's the most important thing. So that dividend is stable, safe, is growing here and there. Okay. And then the profit margin is about 13% right now. Free cash flow right now for about £5 billion pounds. Forecasted for the next couple of years, for the next 3 years, it's about 16-17% from where we are now, which is quite nice. The revenue growth rate is basically about 6%. Simply Save Dividend is actually, Simply Wall Street is saying 31% undervalued at the moment. £151 per share. That's what they expected. Right now it's about £105. Morningstar is saying it's about 15% discount right now. $78 per share is where they think the price should be. So this is one of the reasons I've been buying this. So I've been, like I said in the last video that I've talked about, the 3 stocks that I'm buying is one of the companies that I've spoken about, because I still genuinely think it's undervalued, and I do agree. Even if you take basically at least a 10% margin of safety, you're still up by 5% according to Morningstar, and again the upside from where you are from here onwards, and about another 20% for this one. So it's just absolutely nice to see. Now next one is Sarco Engineering, which is a company that works in steam and electric thermal solutions. Is based in the UK. 7.8 billion market cap. It has a wide economic moat. $105 pounds per share. Dividend yield of 1.5. Payout ratio 64. 10 years of increasing that dividend. Stable, absolutely. Profit margin 11%, 1.93, which is about £2 billion of free cash flow right now. For a company that's $7.8 billion pounds, that's actually really good. Almost free cash flow of almost $2 billion, £2 billion pounds, that is. Forecasted about 13% growth, which is really nice. Revenue growth about 5% expected. And Simply Wall Street is actually saying about 6% overvalued. £99 is where they think the price should be. According to Morningstar, it's about fairly valued at the moment. £65 is where they think the price should be. This is a really interesting company because For the company, that's about 7.8. I think it was 2020 when I was looking at the data. I think they said about 2022 it had almost a revenue of almost a 2 billion. I think it was 1.7 billion pounds, which is really good for what basically a company that is only 7.8 billion dollars. So it's one I'm definitely interested maybe moving forward, and it's actually quite diversified in terms of what they have. The steam specialist side of things in terms of electric thermal solutions and so on. So I will do hopefully maybe dive in a little bit more inshallah in the next few months. And then you've got RB, which is one of the companies that I have in my portfolio. It has come down quite a bit recently because of the revenue has not hit basically the targets that were expected, as well as of course the forecast has not been great. But again, all of these things taken into consideration, if you think about this, is one of the companies that have been around for quite some time. I don't think the business is basically completely gone or anything like that. It's just maybe it's going through a slowdown in the revenue side of things, maybe in a year or two, and it will definitely bounce back. I'm sure for that. Okay, so right now it's about by the way, don't take my word for it. Don't buy this stock if you don't like it. If you're not sure, do your research as well, inshallah. 30 billion market cap right now. Moat is white mode. Price £43 right now. Dividend yield of 4.5%. That's absolutely huge. Payout ratio 84%, which is a little bit concerning because a lot of these UK based companies seem to have a very high payout ratio, which I really don't like. 84 is quite high. Dividend streak, because that means they're using about 84% of their net income to pay as the dividends, which is not good at all. But the dividend is safe. Profit margin about 11%. $2.1 billion of free cash, pounds of free cash flow right now. Forecasted about 12% growth in the next 1 to 3 years. Growth estimate revenue growth rate of about 3%, and is discounted right now about 46% according to Simply Wall Street, and according to Morningstar, it's about 6% discounted right now. $46 per share is where they think the price. 21% discounted right now, and 67% is where they think the price should be. Now, the next company we're looking at, Experian. This is one of the companies that I think I've talked about this one before. Really great company. I know this because of the when it comes to credit, prevent all the fraud side of things, the fact that with credit ratings and all of that stuff, so you can actually if you live in the UK and you're looking for, I don't know, mortgage or something like that, is one of the companies you can go to and just put your credit card details and all of that stuff, and it kind of gives you what you need to do and how you can boost your credits and all of that stuff. So 31 billion pounds of market cap right now. It has wide economic moat. Price right now is about 35 let's call it 35 pounds per share right now. Dividend yield of 1.3, payout ratio of 49%, which is the lowest that we've seen so far. And the dividend is volatile apparently right now, not stable at all. Profit margin about 15%. Free cash flow of just less than £1 billion, forecasted to about 13% next year. Revenue growth rate of about 7%. Overvalued about 13%. Fair valued about £31. 34 is where it is now, so it's not far off. Fairly valued according to Morningstar. £40 is where they think the price should be. And the final company is Rightmove, one of the companies that I used to when I was buying my property. So if you want to search any property in the UK, for example, is this one, Zoopla. This one, in terms of I don't know if Zoopla is actually a publicly traded company, but $4.6 billion pounds of market cap right now. It has a wide economic moat. So all of these companies have a wide economic moat, which is quite nice to see. £5.80 right now. 1.6 dividend yield. Payout ratio only 38%, which is nice. But apparently the dividend is volatile and fine, but it's basically they don't increase it every single year, so that's what it means, volatile. So some years they might just decide not to increase it, some years they will increase it. Profit margin, we're looking about 55%, and free cash flow of just over 200 million right now. But remember, it's only 4.6 billion market cap right now. So forecasted about 7%, then 7% for the revenue side of things. Overvalued about 2.7%. Overvalued right now according to Simply Wall Street, and fairly valued of £5.65, so not far off from where we are now. Fairly valued according to Morningstar, $6.44 is basically where they think the price should be. So again, all of them are really good companies, but I would love, one thing I haven't done, I wish I did more of, is maybe look at the price appreciation over the last whatever 5 years, 10 years, and compare that, and then see what also the total return is in the last 10 years as well. There's another thing you could do. So there's a lot more that you could do if you're really interested in any of these companies, but I just want to make the video as short as I possibly can. Again, in terms of Sharia compliance side of things, you can pause the video and have a look at it. There is no issues in any of these companies. Again, RB is just the one that has the highest in terms of interest-bearing debt, but the rest of them seem absolutely fine. So again, I will be doing more of this type of videos. If you'd like this type of content, please do like the video, subscribe to the channel, and of course join us in the Patreon. It takes a lot of time to put these videos together, and I would really appreciate and InshaAllah all your support. Have a wonderful day. Assalamu Alaikum.